Hey everyone, I'm Mikey Millions, and in this video, I'm going to show you how to pay less money to Uncle Sam on your 2022 tax bill by using tax loss harvesting, or TLH. Before we go any further, I'm not a tax lawyer, ask your doctor if taxes are right for you, etc. We all know that we must pay capital gains tax on our winning stock and options trades, but most of us, including the buy and hold traders, we have some positions in the red. If we do some intelligent trading, we can use these losses to mitigate some of the taxes we owe on the winners and thus minimize our tax bill. We're going to achieve this using tax loss harvesting. Now, simply put, this is the process of realizing losses in order to offset the gains from other investments. By realizing those losses, you're reducing the amount of overall gain you have for the year, and thus you're reducing the amount of tax you have to pay. But rather than just converting those losing positions into cash in order to realize the loss, we're going to reinvest in similar securities. Therefore, we don't have to really change our market position. We still realize the loss, but we have basically the same position that we had before. While we do that, we have to make sure that we're avoiding triggering the wash sale rule. We're going to talk more about that. Let's use an example to take a closer look at how this works. Let's say you've been trading covered calls on QQQ all year. That's a NASDAQ ETF. QQQ has had a pretty terrible year. It's down about 25%. So you, as the QQQ investor, are bag holding shares. But the covered calls that you've been selling have been bringing you premium that's expiring every month or every week, however often you trade. Thus, you are realizing a continuous stream of gains. The government is going to expect you to pay taxes on those covered call gains. If you were doing this with one lot, that's 100 shares, you're down on your QQQ shares by about $12,000. But let's say in the process of selling these covered calls, you've peeled back $5,000. That's $5,000 of covered call income that is now a realized gain. Overall on your position, you're down $7,000. But as far as taxes go, you have realized $5,000 of gains. The IRS is not interested in your $12,000 of bag holding on QQQ shares. All they want to do is come after that $5,000 of gain. If you do nothing from here, you're going to owe the government taxes on $5,000 worth of income. Depending on your tax bracket, that's going to come out to something like $1,000. So not only did you lose $7,000 this year, but now you have to pay another $1,000 in tax. So here's what we're going to do. We're going to sell these 100 shares of QQQ and realize the $12,000 loss. Now when we balance out your gains and losses, you no longer have a $5,000 capital gain. Instead, you have a $7,000 capital loss. You no longer owe the government another $1,000 in taxes. And in fact, we can use this $7,000 to lower our tax bill. We're going to talk about that more later. All we did so far was realize this losing position. And now we've gone from owing $1,000 in tax to getting a tax deduction. So that first step is all well and good. Yes, we have reduced our taxes by going from a capital gain to a capital loss. But now we have no positions. We just dumped our shares of QQQ. Well, what if the market recovers? We don't want to be holding all cash and missing out on the first leg of the next bull rally. So if we want to keep investing, what do we do? Your first instinct might be to just buy those 100 shares of QQQ right back. Realize the loss, buy them back, and now you have the same position you had before, but you have a realized loss. It's a good thought, but unfortunately, you can't do that. That's what's called a wash sale. Since way back in the 1920s, there's always been a rule where you cannot sell your shares for a realized loss, deduct it, and then repurchase, quote, substantially identical positions within 30 days. It's also a wash sale if you try to pull a fast one by buying more shares first and then selling the losing shares. That doesn't work either. That's still a wash sale. In other words, you can't buy another 100 shares within 30 days, or else you lose the ability to write off the deduction until you do sell for 30 days or more. We really want to avoid that situation. Every year we see people posting how they basically broke even for the year, but they owe $65,000 in taxes. How did that happen? It's because it was all wash sales. Every time they sold a position for a loss, they were buying another position back. All of their deductions for the losses were canceled out because of this wash sale rule. Now they still owe taxes on their gains, and there's really not a whole lot they can do about it. But when we perform tax loss harvesting by realizing our losses, does this mean we're just dead in the water for 30 days? Do we have to sit on all cash? No, we do not. There are ways to get around the wash sale rule. The IRS has indicated that a wash sale occurs when a substantially identical position is reopened or an option is acquired that would allow the trader to open a substantially identical position. What substantially identical means has never really been formalized. So what we have is precedent. Now we know we can't just buy back our 100 shares of QQQ. That's obviously a wash sale. But here's a couple strategies that we can use to reopen very similar positions without triggering the wash sale rule. We know that QQQ follows the NASDAQ. We also know that there's a whole bunch of ETFs that follow the S&P. Now the NASDAQ and S&P, they don't move together perfectly in tandem, but they do generally follow each other. So for the next 30 days, are you willing to go from QQQ to VOO or SPY. These are two different indices, so it's not a wash sale. But you have a similar market position for the next 30 days, and you absolutely haven't done anything to compromise your tax deduction. And on day 31, if you want to, you can just sell the shares of SPY and go right back into QQQ. If you have shares of individual stocks, this is a little bit more challenging because there's no stock that's going to follow Meta perfectly. But if you're bag holding shares of Meta and you want to get a deduction for it, you can sell your shares of Meta and then buy an ETF that heavily weights Meta, like XLC, which has 17% of its holdings in Meta. If Meta shoots up, XLC will too. You have changed your market position, but this isn't a dramatic change, and if you want to, you can go back into Meta on day 31 without losing that deduction. There's also a gray area with things like SPY to VOO or QQQ to QQQM. These are two different ETFs that track the S&P and the NASDAQ respectively. But they have slightly different holdings, they have different fees, there's different management. Some people will say these are substantially identical. If you have two ETFs that by design track the same index, that's a substantially identical position. But there's other people that say this is not a substantially identical position. In fact, you've got people like Harold Bradley from the Kauffman Foundation who say that it's typical for firms to swap between ETFs in a bear market. He even says that they advertise this as an advantage to investing with their funds. Their secret tax advantages are just tax loss harvesting. They're going from one ETF to track an index to another ETF tracking the same index. They don't change their market position, but they still realize the deduction, and they get to show their investors, look how much money we saved you on taxes. For years and years, this has been going on, and there's been no issue. It's going to have to be up to you if you want to sell your shares of SPY and buy VOO. I can tell you that I have done this before. Nobody's ever raised an issue, and I got my deduction every time. But this has to be up to you, and I think most advisors would tell you not to chance it. If you want to be safer, you can do something like going from SPY to VT. That's a total world index. It's definitely not the S&P 500, but you have a similar market position. That's a much safer choice than trying to get around it by buying an ETF that by design tracks the same index. As for the biggest tax loss harvesting that I'll do this year, I have a large position in QQX. That's a covered call NASDAQ ETF. So they're selling covered calls on the NASDAQ to generate income. There are a handful of covered call ETFs that do that, but I prefer QQX for a couple of reasons. I have a video on that if you really want to. But QQX is down this year, right alongside the NASDAQ. I have a nice thick $21,000 unrealized loss on QQX. I'd like to realize that loss in order to offset my tax bill. So I'm going to sell my shares of QQX and buy shares of JEPQ, that's another covered call ETF, for the next 30 days. These funds are very similar, but they run in different ways. JEPQ uses ETNs, where QQX does traditional covered calls. These are different models, and therefore they are not substantially identical. I can go from QQX to JEPQ without triggering a wash sale. I'll pretty much be able to sustain the same market position while also taking my huge deduction on QQX. Now let's talk about an extra few notes and cover some best practices for tax loss harvesting. What if we've done all this tax loss harvesting and then afterwards we actually have a realized loss for the year? What if we didn't just write off some of the losses against our gains, but what if we actually have a total loss for the year? Well, if you're actually red for the year, here's what you can do. You can take up to $3,000 per year and write those losses off from your ordinary income. It'll act as though you made $3,000 less on your job. And if, for example, you have $15,000 of losses for this year, you can only write off 3 of them. Well, now I've got $12,000 of loss left. You can carry that forward into future years. So if next year you make $13,000 in the stock market, you can use this year's remaining $12,000 loss to write off of those $13,000 gains. Now you only have a $1,000 gain that you have to pay taxes on. But if you stay red in future years or you just stop investing, you can continue to roll that $3,000 per year forward until you've written off the entire loss. And second, this is an interesting one, there are no wash sale rules about cryptocurrency. So if you bought Bitcoin at 40,000, now it's at 17,000, you can sell that position in Bitcoin, take your $23,000 loss, and then immediately repurchase the exact same Bitcoin. You don't have to wait at all. This is not going to last forever, but as of now, cryptocurrency is not currency, so there is no wash sale rule. I tell you now, it would be a terrible mistake for you not to take advantage of this if you have any cryptocurrency positions in the red. And lastly, don't try to get around the wash sale rule by buying your same positions back in another account or in someone else's account. You can't sell your shares of QQQ on Robinhood and then repurchase the same position on Webull. That's a wash sale. You also can't sell your shares in your own account and then buy them back in a spouse's account. However, this rule does not apply to girlfriends and side pieces. So if you want to sell shares in your account and then buy it back in your girlfriend's, or you trust your side piece, you can do that. In any case, I hope this video has been a good starting point for you to do your own due diligence on your tax situation. Again, ask your tax advisor if this is a good move for you. And don't trust random strangers on the internet for tax advice, especially if they have entrepreneur in their bio. Thanks for watching, and I'll see you guys next time.